at tax as a risk component in your portfolio and your estate and your affairs is actually a pretty important thing to do. That's why we always advise our clients to make sure you have a very credible attorney and CPA that helps guide you through this along with our help. You can do all the estate planning you want and take your liquid assets and move them into trusts or protect them in other ways. But by and large, a lot of our clients over the years have used 401ks and IRAs and things like that, and they find they're getting into their 50s and 60s and they're sitting with $2 million, $3 million, $5 million, $10, $12, $15 million in either a 401k or an IRA that has just grown exponentially over time. That's actually not considered part of your estate until that money has been taken out, you've had constructive receipt of it, pay tax on it, and place it in the taxable asset side of your balance sheet. There's some real tax risk that goes along with that. The whole idea of putting the money in the IRA and the 401k in the first place is, hey, I'll put all this money in there, and then later on in life I retire, my income isn't as high, and I'll pull it out and I'll be at a lower tax bracket. That's usually not the case with most of our clients. They have this, and any money that comes out of their IRA, usually on a forced distribution once they get into their 70s, that's usually at the top line of their tax return as far as the highest taxable rate that they pay. So there's ways to go about managing that risk, and if you get into some deep estate tax planning, you could do a lot of things to protect yourself on the taxable side and put and move your money into different types of trust structures and whatnot.